All right, gentlemen, I want to make a video because it seems that in the last week, somehow everybody in the world became some fantastic economist or financial expert. All right, so we did have a fantastic week in the stock market. You got, kinda not really though. Like, you got a lot of people talking about stocks, focused on stocks. The only reason why is because stocks went down a little bit. And it's like, bro, you were at 200%. Okay, the total stock market capitalization to GDP is the Buffett indicator. Stocks were priced at 200% of GDP, the most expensive they've ever been. And it's been like this. They've been elevated for over a decade. It's because you have central planning in this country, right? So is what it is, bro. Like, you've had central planning for a long time. You've not had a free market in America in over 100 years. So for all the blue-haired folks, Kia and Teslas or whatever they're on to, dumb shit now, these folks denounce capitalism, and it's like, we haven't even seen free markets in 100. Nobody knows. You have central planning of your money. You have central planning of credit markets. You don't have a free market, all right? You don't have capitalism. But we're not here to criticize and suggest what should be. We're just going to analyze what is. I just don't understand why everybody is suddenly some expert on financial markets, why people are freaking out, aside from the fact that their stocks went down just a little bit, which they deserved to do. They were too expensive. Okay, let me see if I can find this chart here. All right, here's the stock market. Oh, actually, there's a 10-year yield. Okay, so everybody on Twitter right now is, and yeah, I'm going to keep calling it Twitter. I don't give a fuck. All right, everybody's talking about how the 10-year yield is going up. All right, yeah, sure, big deal. All right, yeah, big deal. I mean, yes, I will give this to you. 60 basis point move from 3.9% to 4.5%. That's a big jump, sure. In a week, big jump, yes. But, like, historically speaking, is this really that big of a deal? In a short period of time, yes. And could it portend or come before? Like, if we get a crisis that happens, is anybody going to actually be surprised? No. You've had market interventionism for way too long. You've got just the money printers on. All right, you've got, like, the basis trade, and we'll get to that in a second, and whatever. The basis trade is absolutely retarded, all right? Like, this notion that you can, bro, the repo market blew out already in 2020. So if we get another blowout in, like, the repo market, or hedge funds need another bailout, or the Fed finds another reason to turn the money printer on more, is anybody going to be surprised? I am not, all right? But from a historical perspective, is this really that big of a deal? I think not. Like, where were all the experts right here when the 10-year jumped from 1.6% up to 3.5% in a couple weeks? Like, you know, what'd you get? I believe this coincided with a bit of a decline in equity markets, and so perhaps everybody was a financial expert. But it's because equities have dropped quite nicely over the past little bit, and suddenly everybody's just an expert. All right, here's what we're dealing with here. Like, here's what we're actually dealing with here. Let's jump to this chart. Bro, this thing is just off the charts. We're dealing with this. All right, here's why everybody's whining. All right, they got this. All right, they got socialism for the rich, free money printing, bank recapitalization here, bailed out the system. Free money, all right? I didn't hear any of these people crying when their asset prices were being propped up. What is this, 2020, FOVID, all right? I didn't hear any of these folks crying when they got all their asset prices propped up. This has been like free money printing. This is all this is, free money. And there's no such thing as a free lunch, so, I mean, that's just a phrase. But mind you, you will pay the piper, all right? There's no such thing as a free lunch, no free money. But the point is, the market has been artificially propped up through the central bank, and somehow you come back and you get a little bit of a retracement, which is actually a fantastical, like, talk about technical analysis. It really does not get better than this. Let me explain this to you here. Look at this. All right. You put a little trend line there. Right? Let's go to dark mode. Now, you put a little horizontal line here. Bam. Look at how fantastic this trade is. Like, I get it. People can't handle a little bit of a retracement, all right, in price, but like this doesn't make any sense. This is just normal market movement, like normal market fluctuations. And I get that this is abrupt, but the earnings yield on the S&P 500 right here, I believe earnings on the S&P 500 right now is about $250 for the entire index. If you divide that by, what was the high? We'll say 6150. Rough napkin math, 250 divided by 6150 gives you about a 4% earnings yield. And 250, what is earnings right now? As of December 31st, 2024, so year end, you're about 210. Right, so 250 would be, and this is old, this is old data, but can we get current data? Macro trends, what do you have for us? 220? Right, 210? Yeah, so if you got, let's do that formula. 211 divided by 6250. 3.3% earnings yield. Right. That's also what I saw earlier. So, roughly speaking, you got an earnings yield of about 3.5% to 4%, depending on how you calculate earnings here. Now, that is below the 10-year. The 10-year at this time is trading at roughly it was about 4.25%. Let's go look. It's S&P. What do we got? 2 S&P charts? What happened to us? All right, 10-year. Bam. Okay. So, we don't need to get too specific here. What's the date? January 25, start of the year. January 25. Right. So, at the beginning of the year, the 10-year Treasury was at 4.7%, while the S&P 500 earnings yield was roughly 3.5%. So there was no equity risk premium. There was no incentive to be invested in stocks, right? So all these people that are crying about how tariffs have ruined the economy, who knows? We'll see. What happened the last time there was a trade war? We got on. Where was the last trade war? Donald Trump was in office when? Here? So stock market has been money printed into the sky, and prices went beyond what was reasonable. Because right here, you've got an earnings yield of 3.5%, and you've got a 10-year Treasury yield of about 4.7. Let's call it 4.5. All right? So, in other words, if you believe in the misnomer that government debt is risk-free, then there's basically no incentive to own equities at this point, right? There's a few, and I'm not saying don't own equities, because there's some that you can own. But for the most part, let's move my head down. For the most part, this is just natural market movement. Like, yes, you can complain about, I get that it's a sharp decline, right? This was what, 2020? And I understand that the decline here is rather precipitous. But from a technical perspective, from a valuation perspective, what goes up must come down. So you were at such sky-high levels here that there was no equity risk premium. And in fact, there was more of an incentive to own bonds by about a percentage. So explain to me why everybody's like some genius now that they've like figured out that monetary interventionism and propping up the market is like a bad thing. Like what's also funny is so Trump came out, and he said tariffs. And this is a complicated story because he said tariffs and they go tit for tat. He rolls out tariffs. I forget what everybody gets tariffs. China gets 34% tariffs. Everybody else gets 10% tariffs, roughly. Mexico's excluded, so the Mexican stock market does fantastic. Interesting. All right. And then Trump ups tariffs on China to 54%, and then suddenly they jump overnight to 104%, and now they're up to 125%, and Beijing had responded, and now theirs are up to 100%. So it's just this couple kids in the schoolyard scrapping, right? Naturally, uncertainty is terrible for the market, especially a market that's so elevated where you've got no equity risk premium. Like, just look at the fundamentals, and you don't need to make this complicated. There was no equity risk premium. NVIDIA was trading at like 100 times earnings. All these tech companies, the Magnificent Seven, like they're all trading at ridiculous valuations at the start of the year, right? NVIDIA was up at 100 times earnings, 60 times earnings, whatever it was, right? It's a great company. Fantastic growth, but just the valuations on these companies are ridiculous. Like, what is Tesla's valuation even now, even after they've engaged in this? I thought they were saving the environment with these Teslas, and suddenly everybody hates Tesla, right? What was Tesla's price to earnings when it was trading at $482? I don't know. Yeah, we want to leave. All right, TSLA. PE, still at 123. So, like, how is this rooted in any sort of sanity, right? Like, it's not. This price is, like, still overvalued ridiculously. And you look at their, like, you could make the argument that they deserve some ridiculous sky-high price back in 21 when they had 70% revenue growth. Fine. No argument there. But then growth declines, 51%, 18%. No growth, right? And so unless they get these numbers up, the stock price falling makes perfect sense. And even 100 times earnings with 70% growth, even that's a stretch, because you know that growth can't be sustained ad infinitum. What else we got? Apple didn't make any sense either. You look at Apple, they were trading at 34 times earnings. Now they're back up to 31 times earnings. Still doesn't make any sense. All right, this looks like an incredible short. Maybe not. I don't know. Technical analysis, maybe not. But I would not be surprised if they came up to 210 and then they went back down. Of course, you don't want to short productive enterprise. You don't want to short the iPhone monopoly. But where's the growth here? $365 billion in 21. Trailing 12 months, $395 billion. So, like, their growth rate is roughly, I don't know, 3%? Like, no growth. So why is this stock trading at 31 times earnings or an earnings yield of about 3%? Like, it doesn't make any sense. So the notion that everybody's just some genius now and they understand financial markets, everybody's talking about the 10-year treasury and whatnot, it's like, no, y'all were just retarded. You were all just bidding up the assets to like unsustainable levels. Anyway. It's interesting to note that gold did get a bid. Gold is just on a phenomenal run. Up 23.3% year to date. Look at this. This, ladies and gentlemen, would be called a cup and handle. Here's the handle. Here's the blowout. Incredible. And here's the thing. I said this somewhere. I said gold is the only risk-free asset. And somebody's like, oh, is it really risk-free? Yes. According to Basel III banking regulations, gold can be held by banks on their balance sheet as a Tier 1 asset, equivalent to treasuries and cash. So from that perspective, it's risk-free. From the perspective that gold is money and everything else is credit, as J.P. Morgan said in 1912, gold is risk-free. And from the perspective that 1 ounce today will be 1 ounce tomorrow, gold is risk-free. Now, if you measure it in paper, will there be a time when you buy here and perhaps it goes down? Maybe, right? But this is looking pretty Weimar-like. I mean, it seems like we're all sitting on toilet paper, and this is starting to kick off quite nicely into the crack-up boom. But who knows? Maybe this retraces. But, I don't think gold stops here. I don't think that, I like, let me know when we're talking about $10,000 or $20,000 an ounce gold price in terms of paper dollars. Then maybe we'll talk about whether gold is too high or not. All right, what else we got? I don't know, same headlines across the board. You know, everybody, like, here's the thing. All these mainstream financial news publications, they just want to bash Trump. Like, that's all they're interested in doing. Let's get how one of the wildest weeks in market history unfolded. Well, yeah, it unfolded because you had no equity risk premium, gentlemen. Like, it's not hard. Not hard. All right? Like, let's just skip it. I think I've demonstrated the point, right? But all of these financial publications, remember, they hate Donald Trump. And they blame him for tariffs. How America's wealthy are positioning themselves during the market turmoil. Is it turmoil, or is it just a little bit of a correction? Helen Hunt's doing fine. You know? Like, what do you have to worry about? Helen Hunt is selling her $14.9 million Spanish-style house. It's fine. Anyway, who gives a shit? All right, I do want to show you one more thing. The numbers. All right, here's a couple of companies, right? A couple of good, solid companies. We're looking for a portfolio. Let's go there. All right. We're looking for a portfolio of first-class companies characterized as having significant, stable, growing revenue, large margins, high returns on invested capital, limited debt, offered at a reasonable price. With an emphasis on significant growth and stability. We want stability of earnings because earnings are everything. And this is one more headline I want to actually address. All right. So during the week, when you got this sell-off, a couple days, the market was down by 10%. It's like, not a big deal, really. I might actually post this video, but anyway, I'll just get on with it. There was a headline that said, market loses $5 trillion overnight. And of course, as you get to equity asset markets being as propped up as they are, and just growth in general, right? Like, as the world goes on, as the more money gets printed, we were talking about billions back in the day. Now we're talking about trillions. Pretty soon we'll be talking about quadrillions. And in fact, banks are speculating quadrillions in derivatives. But anyway, the point is, the more you go on with the system, the larger the numbers get. And most of the growth in most things is actually just a result of credit expansion or inflation. And pretty soon you start talking about big numbers. My point is to say that when you see a headline in the Wall Street Journal that's like $5 trillion wiped out overnight, or $5 trillion just gone overnight. Well, number one, the numbers are getting larger and larger and larger. So, of course, every time you get a correction, it's going to be a record. So to say like a record $5 trillion was wiped out overnight, it's like, have sound monetary, like have a sound money, and then you won't be talking about always exponentially larger and larger figures. But since you have debt as currency, which is a slave system necessarily, which is what I believe that we are getting past. I believe that the world, for better or worse, is waking up to the fact that this slave system no longer serves us, right? This coincides with the recapitalization of the banking system in 2008, the advent of Bitcoin and distributed ledger technology, and now you've got distributed ledger technology, which allows us to get past the debt-based monetary system. See, back in the day, this is what Wall Street does. Wall Street, the finesse of Wall Street is to swap assets for debt. That's what they do. They find a good asset and they swap it for their debt, all right? You used to have gold as money back in the day in the United States, and this is how the American Republic became the most prosperous country in the history of the world. You had sound money, so you had a sound economy. You had morality. You had other good, like the economy was sound. Now you have degenerate money, therefore you have degenerate people. All right? They didn't used to have 7-Elevens where people were wiling out and doing all this stuff that you see on social media these days. That's the result of degenerate money. You get degenerate people. Now, We use debt as currency, and that is a mechanism to steal your time. Everybody knows that this is illegitimate subconsciously. They just don't know it consciously, but you can tell. Rising populism, rising wealth inequality demonstrates this. And people are wising up. Even the people who make a bunch of money because they have assets, they know it's illegitimate. They know that winning at the expense of money printing, which comes at the expense of the rest of everybody else who doesn't own financial assets, they know. And the people at the bottom who don't own financial assets, who see that their egg prices are going up, they also know that something's amiss. The funny part is the DOJ is investigating Cal-Maine for rising egg prices. And it's like, bro, how is Cal-Maine getting investigated for rising egg prices when you had the Joe Alzheimer's regime who printed 40% of all dollars in existence they printed during his cartel's tenure, all right? Whoever was running the real show, all right? It wasn't that asshole. Anyway, back to the credit system, the monetary system. So the real opportunity we have here is that, let me adjust this. All right, the real opportunity we have here is that people are wisening up, whatever, is that a word? People are waking up to the scheme. The scheme is that you don't have money. You have credit. You have a currency. And that currency is debt. My point in saying that gold used to serve as money is to say that in a market economy where you benefit from exchange, and exchange allows for the division of labor. The people elevate themselves beyond an agrarian lifestyle, and the shoe cobbler can make shoes, the steel guy can make steel, and whatever. In the modern day, the software developer can make software, the fisherman can fish, and they all exchange their specialization. They go specialize, right? This is called the division of labor. They specialize. And they each do their respective trade, and in exchange for their production, they trade their production for money, and then money is used as a means to save value over time. Or you could say money is a means to store energy over time. Or it's a means to store their time that is successfully expended in some productive endeavor. However you want to say it. But it's really illuminating when you really think that money is just a method for all of us to store our time. Or it's a method to store energy over time. However you want to look at it. The point is, if you exploit the money, then you exploit the people, right? And this is the big to-do about the whole financial system in the modern day. It's a giant finesse. In the market economy, where you have the division of labor, men become dependent on the money. And so that's fine when the money is neutral, like gold. When the money is replaced with credit or debt, and that's what your money is these days, it's debt. When you depend on the debt that's issued by a small minority of men, the banks, and the people who own the banks, small group. When the vast majority of men become dependent on the banks, they become subservient to the banks. This is the problem of this fake credit system. Or you could say this is the problem of a currency system based on debt issued at interest. Their debt is issued at interest, and it is repaid with debt. So you see it's a circular system because there is no debt to repay the interest. So it's a loop, all right? It's an exploit. It's a way to exploit the system. And moreover, money in the modern day is exploited. It has become political. Russia was kicked out of SWIFT. Iran is kicked out of SWIFT. Like certain people, you're like, what issue do we have with these folks? I don't know. I don't know them. Why are we kicking them out of the payment system? But as Americans, you want to have a cheap mortgage and you want to have the world's reserve currency. So it doesn't make any sense. You like kick out 1/3 of the global economy from using your payment system, but then simultaneously want to have dollar hegemony, ubiquitous use of your currency. It doesn't make any sense. Anyway, the issue is that in the modern day, you have a currency that's issued at interest, and it's a mechanism to siphon all of your time into the hands of a small group of individuals whose names you do not know. And if you want a nice artistic demonstration of this system, go watch the movie In Time with Justin Timberlake. Everybody has like a little, like a clock, a digital clock on their arm, and it's a counter of the number of units they've got, and it's always counting down, and if it expires and goes to zero, you die. It's a pretty spot on analogy. All right, very nice artistic film. At any rate, how do we get on this tangent? I don't know, but I just, this is the problem that we are working to overcome. And it's interesting because as the stock market starts to fall a little bit, a little due correction, all right? Like, wow, you had an equity, like you have zero equity risk premium or a negative equity risk premium, and you want to complain that stock prices went down. It's like there was no incentive to buy stocks over bonds, except for bonds are like dog shit. Here's the other thing too. Here's a misnomer. Since we're on this tangent here, there's a massive misnomer in what is risk-free. Okay, here's why gold is getting bid up like a rocket ship, is because the entire financial system in the West is based on a misnomer. And the misnomer is that government debt is risk-free. And this is taught at every business school in America. The intelligentsia goes to reinforce the system. Go figure. Anyway, what they say at every business school in America is that government debt is risk-free because a government that issues debt, that also issues currency, can always repay the debt with currency. It completely disregards and ignores the fact that doing that debases the currency's value. Therefore, the bonds are not risk-free because the unit in which they are repaid is worth less than whence the money was originally borrowed when the bond was sold. It's striking to me, incredible to me, that this is inflation destroys capital. And I saw this New York University professor who was teaching for 25 years. He was teaching for 25 years and he was on some Bitcoin show or something. And he was like, I never understood that inflation was like destructive. It's like, bro, inflation destroys capital, all right? Inflation destroys capital. And you need to, if you want a perfect demonstration, look at Venezuela, where in 2017, the average citizen lost 11 kilograms, was that 20 some odd pounds, in a single year because the shelves were empty. They could not get food. And over 60% of people went to bed hungry. This is because of inflation. So not only does inflation consume financial capital, it consumes human capital. So this is why people understand. This is why people are so against the Fed. People are so against central banking. People are so against inflation because it is theft. There's no other way to say it. If you say it otherwise, you're lying because it's theft. Inflation destroys capital. So, this is why gold is getting bid up, because gold is a risk-free asset. And the people who say, oh, it's not risk-free, the price can go down. In terms of paper dollars. Anyway. To get on with the show, let's go look at a few companies. So we've got this spreadsheet. Here's a few first-class companies we're looking for, right? Now, we've got the ticker, the company, its current market price, its earnings per share, its PE ratio, and then its earnings yield. The earnings yield is just earnings per share divided by price. So the earnings yield is the inverse of the price to earnings. So this could also be E divided by P, right? So we've got the earnings yield. Now you look at these companies and you realize that very few of these, currently, the 10-year yield is 4.5%. So let's run through these and look and see what company has an earnings yield that exceeds the 10-year yield. You see NVIDIA. And this might be one of the only companies that you could justify investing in because the growth rate is so fantastic. Last quarter, year-over-year growth is still 70%. So you might be able to argue that you would disregard the earnings yield altogether because growth is so fantastic. And had you paid attention to NVIDIA's price, you would have realized a couple days ago this was a pretty solid buying opportunity considering how expensive it has been historically. But moving right along, Google, 5.2% earnings yield. Okay, reasonable, not excellent, but reasonable. Taiwan Semiconductor, 4.5%. So, right on par with the 10-year. Now, what you can say about equities is they grow over time, whereas a 10-year treasury debt is just fixed. So, relatively speaking, each year, if Taiwan Semiconductor grows at 15%, then yes, you're buying an equity coupon, right? So think about a bond coupon. That's your 4.5% on a 10-year treasury. You're getting a coupon. Each year, you're getting 4.5%. Taiwan Semiconductor, your earnings are 4.5%, but this equity coupon can grow over time. So there is something to be said about an equity coupon, which can grow. Visa, 3.1%. PDD Holdings. I actually think that this is really interesting. All of these, none of this is investment advice. Do your own research. You're responsible for your own risk. All investments can go to zero, etc. Disclaimer, done. Now, PDD owns an app called Pinduoduo. They also own Temu, which I'm sure you've seen on Instagram. Now, with Trump tariffs, Temu might be kaput. Who knows? I believe there's now a $25 minimum tariff on any import, so it's going to make it difficult to ship a bunch of Chinese junk to your front door. But Pinduoduo is a massive app with 900 million users, and most of them are in China. So, and it's an app that connects producers directly with consumers, and they use a social buying model to push their products. Anyway, interesting because they have a fantastic growth story, and they have gotten relatively beaten down in the modern day. And if you say Pinduoduo, I think a lot of folks are going to say, oh, I don't know that I want to own that. And that's probably when you want to start thinking about owning it. All right. Meta Platforms, 4.4%. Pulte Group, home builder, 15.7%. Relatively attractive in my opinion. Obviously, all of these stocks are getting beaten up as of the market's falling, and so people are going to liquidate a lot of things, and a lot of stocks are going to continue to go down, perhaps. And so any of these companies, you, as an equity owner, you have to be willing to own for the long term. But in terms of whatever happens next, you know they're going to print money, right? If the basis trade is really blowing out, maybe we touch on that in a sec. But if the basis trade, actually, let's just get into that. Real quick, I'm not some repo market expert, but I do know that back in 2019, right before COVID, the repo market, short-term credit market for, what do? They pledge treasuries as collateral to borrow. Whatever. Anyway, it's a short-term credit market secured by treasuries. The interest rate on the short-term credit market blew out right before COVID. And you've heard nothing but problems ever since. And I believe the Fed has had to bail out hedge funds engaged in this market. And the issue with this market seems to be that, again, I'm not an expert on repo, but it seems a little odd because I believe that these hedge funds get repo loans and they get a loan to go buy a treasury. They buy the treasury and then they use the treasury as collateral for the loan. It's like this kind of like frivolous, circular. I don't really get how this is like even legitimate. Anyway, I don't know. It's like there's like no equity to this market. The point is that these hedge funds have 50 to 100 to 1 leverage in this market. They're getting a loan and then going and buying the collateral and then pledging the collateral for the loan after the fact, I believe. And then they can just do this. I don't know. I don't know that they're doing it on a consistent. We need a repo expert here. But what I'm saying is, from what I gather here, this trade is blowing up because this is done by hedge funds because they buy treasuries in the spot market and they sell futures forward and they try to capitalize on some marginal spread. And if there's volatility, this spread blows out and the trade blows up. And so in a week like this week, when the 10-year treasury jumps 50 basis points in a short period of time, apparently this trade blows up because the underlying collateral against which they are borrowing can fluctuate to a significant degree. To give an example, a 50 basis point move in a treasury can cause its value to fall by 5%. And so the problem is that the repo market has very, very thin equity requirements. You can go basically get $100 million in treasuries, pledge them in the repo market, and borrow $98 million. And this is done, they say, it's done on an overnight basis, and treasuries are perfectly good, risk-free collateral, and it's very highly liquid market, so this is okay, is the logic. But the problem is that if you have a loan for $98 million secured by $100 million in collateral, and you get a 50 basis point spike in the underlying collateral, which causes its value to fall by 5%, suddenly you have a problem because your $98 million loan becomes under-collateralized because the collateral drops from $100 million down to $95 million. And so it causes a bunch of issues, all right? Selling. And this is where the Fed ends up getting phone calls saying, hey, the repo market blew up again. The hedge funds speculated. And the point is, remember how they all got bailed out in 2008? They're continuing the Fugazi. They're continuing the casino because why not? The financialization must continue. And so you got more issues brewing in the repo market, it seems. So if the Fed has to step in the coming days and suddenly everybody becomes an expert on repo, and they're like, yeah, remember how everybody became like a mortgage-backed security expert after 2009? Anyway, would not be surprised. But we don't need to become experts on all of the things. And in fact, we need to think back to the Buffett quote that you don't need to be a genius to make money in the stock market. You just need to stick to your circle of competence, and you just need to do intelligent things. And for the most part, you need to sit on your hands and do nothing. Now, let's get back to the numbers real quick, and then we'll wrap this up. Pulte Group. This seems like my point in saying all that repo nonsense was that no matter what happens next, they're going to print money. Like the U.S., the dollar is inevitably going to lose reserve currency status. And this warning is being sung by, I was going to say Lloyd Blankfein. We haven't heard from that guy since we saved his 15 Central Park West penthouse. I hope Lloyd Blankfein, thank God we recapitalized the banking system so that Lloyd Blankfein could sail off into the abyss. I hope Lloyd Blankfein is doing very well, right? He got to keep his 15 Central Park West townhouse, and life is probably pretty good. Anyway, Larry Fink has, granted, this guy speaks at the World Economic Forum all the time, so, do we trust him? Not really. But does he own and operate a $10 trillion asset manager, BlackRock? Yeah, so, he probably knows a thing or two. In his 2025 letter to shareholders, he gave us a nice warning, which was that the rising debt levels in the United States are going to make it such that the interest payments on the debt are going, plus mandatory payments like Social Security, Medicare, Medicaid, are going to require, interest payments plus mandatory payments are going to consume all of the federal government budget, meaning that the United States will be in permanent fiscal deficit. U.S. GDP will probably be beyond 130, if not 150%. Reinhart and Rogoff, two Harvard professors, wrote a book called This Time is Different, which is a study of over 200 some odd sovereign defaults. And they basically state that we all need to go buy some land and some real assets, really. But they state that once you exceed 130% of GDP, there's no real reversing the locomotive that's headed for the cliff. You're going for the cliff. All right. Anyway, whatever happens next, they're going to print money. So, is this going to result in the dollar losing its reserve currency status? Yes. When? Who knows? But will it? Yes. 100%. Yes. Certainty within our lifetimes. No empire goes on forever, and you have this profligate empire of rising populism. You're going to lose reserve currency status. Is the Zion Dawn here to help us go through the bankruptcy and restructuring of America? Maybe. Who knows? I don't know. Anyway, getting back to the numbers. Pulte Group actually seems like a reasonable earnings yield. Of course, if their earnings get decimated, but they're going to print, so housing. Mercado Libre. This is a Latin American app marketplace. I don't even know what the hell they do. Seems fantastic growth. Seems interesting. No earnings yield. Novo Nordisk. They're one of the proprietors of these fat injection things, Ozempic or whatever. And other diabetes medicine. Interesting company. Bank of Georgia. Here's a bank out of Georgia. Says it in the name. Georgia. Not to be confused with Georgia. The foreign Georgia, not the Atlanta, Georgia, where everybody's wiling out. Foreign Georgia. This bank is interesting. Do your own research. Look into them. The return on assets is pretty fantastic. I believe a 3 or 4% return on assets. Fantastic growth. Really interesting. Li Auto, another one that got on the radar. I want to look more into these folks, but, China? What do you guys think about China? Investable? I don't know. It seems like they've got a lot of growth if these numbers are real. Interesting growth stories over there. Or a lot of fraud. Not sure. BYD, another EV company. All right. FIX, Comfort Systems. You know how everybody says, oh, yeah, HVAC. You just hear about this fucking HVAC all the time. People are like, oh, yeah, HVAC. Here you go. HVAC system. Let's go take a look at them real quick. Comfort Systems. Let's just look at their financials, and then I'm going to wrap up here. In fiscal year 2020, they did $2.8 billion in revenue. 2024, they did $7 billion. Fantastic growth. 34% year over year. All right. Net income, also a fantastic growth story for the most part. You look at their statistics. The only downside is they're relatively expensive. 4.2% earnings yield. But in terms of stability, this is kind of what you want to see here. Just rising revenue, rising net income. Interesting company. Price to earnings growth ratio. Here's why I bring them up. Because this is one of the only companies that is priced below its earnings growth. them and NVIDIA. So although their earnings yield is low, they are still priced below their earnings growth rate. At any rate, do your own research. And I don't know, why we make this stream? I just think that it's a little ridiculous that you get monetary interventionism for the past decade and a half, which props up all asset prices such that equity assets, the total market capitalization of U.S. equities is over 200% of GDP. And then we get a little bit of a decline and everybody's whining. I mean, I think that stocks should still decline another 50%. Now, what fair market value? What would be like the reasonable? Let's end with this. Let's suppose that earnings are, we'll give you a generous, let's say they go up 250. Yeah, I don't know what 2025 S&P earnings are going to be, but let's just say we go with the higher figure to give you the benefit of the doubt. Let's say you require a 6% earnings yield, which would be like still probably low with a 4.5% 10-year treasury. But even so, if you had if you required a 6% earnings yield, that would give you a 1.5% premium over the 10-year. You'd still be at 4,166 on the S&P 500. So, yeah, I don't know. You know, if stocks fall further, like, you know, no big deal. Anyway, the point is, everybody else is like freaking out. I just don't understand. Like still nothing's like that on sale. Like, let's get some liquidations. Let's get you need a real crisis. And then if you get a real crisis, then that's the real opportunity to buy stocks. All right? If you understand what you're paying, you understand valuation, then you can just buy and be satisfied with the price you pay. After all, securities markets are just auctions, and it's the individual who is willing to accept the lowest yield who wins the auction. So just make sure that you're willing to pay the price that you actually pay. Beyond that, disregard the rest of the market. Beyond that, are we going to get some problems with markets? Yeah, eventually, yes. You can't intervene in markets like this for over a decade. You can't kick people out of your payment system and expect everybody to use it. There's like a lot of nonsense going on. You know, is the Zion Dawn driving us towards bankruptcy? Who knows? But it'd be foolish to pretend like suddenly everybody, we all just became financial experts overnight. I don't know, and you don't have to know. That's the thing. Nobody knows the future. So get off social media and stop listening to people who pretend like they know the future. They don't. I'm going to leave it there. Everybody have an excellent life. Good luck.